Let me give you a number that most people never actually sit down and calculate. If you buy a $400,000 house today, by the time you finish paying it off, you will have spent over $1 million. Not $400,000, $1 million. The mortgage interest alone on a standard 30-year loan at current rates adds over $400,000 on top of the price. Then property tax, every year, never stops. Then insurance, then maintenance, then repairs. And here's the part that nobody says out loud. Most people buying a house right now are not building wealth. They are paying for the feeling of building wealth. And there is a very big difference between those two things. I am not going to tell you never to buy a house. What I am going to do is show you every single thing they do not tell you before you sign, so that if you do buy, you do it with your eyes wide open. And if you don't, you understand exactly why waiting might be the smartest financial move you make this year.
Let's start with the mortgage, and I mean the real mortgage. Most people look at the monthly payment and think, okay, I can handle that. But the monthly payment is just the beginning. Here is what actually happens over 30 years. On a $400,000 home with a 20% down payment, you are borrowing $320,000. At a 7% interest rate, you will pay over $420,000 in interest alone. Read that again. You borrow $320,000. You pay back over $740,000. That is before you have spent a single dollar on anything else. Now add property tax. The average sits between 1 and 2% of your home's value every year. On a $400,000 home, that is $4,000 to $8,000 a year, every year, whether the market goes up or down, whether you use the house or not. It does not stop. Add home insurance, around $1,000 to $2,000 a year, and it goes up almost every year. Now add maintenance, and this is the one that shocks people the most. Financial experts recommend budgeting 1 to 2% of your home's value every year just for upkeep. Roof, boiler, plumbing, windows. Things break, things age, things need replacing. On a $400,000 home, that is $4,000 to $8,000 a year, just to keep the house in the condition you bought it in. So let's add it all up. Mortgage interest, $420,000. Property tax over 30 years, roughly $150,000. Insurance, $45,000. Maintenance, $120,000. Total real cost of that $400,000 house, over $1,100,000. And most people sitting in the bank signing that mortgage have never done this calculation.
Now here is where most people push back. They say, yeah, but my house goes up in value. It's an investment, it builds equity, and that is true, to a point. But let me show you what the actual numbers say. The U.S. housing market has returned an average of around 4% per year since 1940. Sounds reasonable. But when you subtract inflation, which has averaged around 3% over the same period, the real inflation-adjusted return on housing is closer to 1% per year. 1%. Meanwhile, a basic S&P 500 index fund that anyone can open in 20 minutes has returned an average of 10% per year over the same period. 7% after inflation. Now, I want to be careful here because I am not saying the stock market is better than a house. A house gives you stability. It gives you roots. It gives you something your landlord cannot take from you. Those things have enormous value that you cannot put on a spreadsheet. But the idea that buying a house is automatically your greatest financial investment, while ignoring the interest and the taxes and the maintenance and the opportunity cost, that is where people get into serious financial trouble. And the most dangerous part? Nobody explains this before you feel pressured to buy. Oh, and one more thing about renting that nobody says. When you rent, your monthly payment is the maximum you will ever pay that month. When you own, your mortgage payment is the minimum, because the boiler does not care about your mortgage schedule.
You have probably heard this your entire adult life. Renting is throwing money away. I want to show you why that is not as simple as it sounds. When you rent, yes, you are paying towards someone else's mortgage. But here is what people forget. When you buy, for the first 5 to 7 years of your mortgage, almost every payment you make goes straight to the bank as interest. Not to your equity, not to your ownership stake, to the bank. On that $320,000 loan at 7%, your very first monthly payment is around $2,100. About $1,800 of that is interest. Only $300 builds equity in that first payment. So, yes, when you rent, you are paying a landlord. But when you buy, for the first several years, you are also paying a landlord. Just a landlord in a suit. The bank. Now, add the full monthly cost of ownership, mortgage, tax, insurance, maintenance. On that $400,000 home, the real monthly cost is closer to $3,000 to $3,500. In many cities right now, renting the same property costs $2,000 to $2,500. That is a gap of $1,000 to $1,500 every single month. $12,000 to $18,000 a year that a renter can invest, or save, or use to build a financial buffer. Renting is not always throwing money away. Sometimes, depending on the market and the timing and your personal situation, renting is the most financially intelligent decision you can make. The problem is, nobody tells you this when you're 28 years old and everyone around you is buying houses.
Let me tell you about Joe. Joe is 29. He has been renting the same apartment for 3 years. Good job, decent salary, and a feeling that has been building for about a year that he should probably buy a house. Not because he has done the math, because his friends are buying. His parents mention it every family dinner. His colleagues talk about property like it is the only grown-up conversation that exists. And Joe felt that pressure, that quiet sense that renting is temporary, that buying is what adults do, what responsible people do. So he found a house he liked, $380,000. He ran the mortgage numbers, $2,040 a month. He thought, I can handle that. That is less than I expected. And then, for the first time, he sat down and did the full calculation, the real one. Mortgage, $2,040 a month. Property tax, $420 a month. Insurance, $130 a month. Maintenance budget, $317 a month. Total monthly cost, $2,900. He was paying $1,800 in rent. That is $1,100 more every single month. $13,200 more every year. For a house in a city he was not sure he wanted to stay in for 10 years? With a financial buffer that was smaller than it should be? With monthly costs.
Now, I want to be clear about something. Buying a house can be one of the best financial decisions you ever make, under the right conditions. Here are the 3 I would never ignore. Number 1, you plan to stay for at least 7 years. The first 5 to 7 years of a mortgage are dominated by interest payments. Equity builds slowly at first, and then accelerates dramatically in the later years. If you sell before year 7, in most markets, you will lose money after transaction costs and the interest you have already paid. If you stay for 10 or more years, the numbers start working strongly in your favor. The house becomes what people always said it was, an asset. Number 2, the total monthly cost, not the mortgage, the total cost is under 30% of your take-home pay. Not your gross salary, what actually lands in your account every month. Mortgage plus tax plus insurance plus maintenance. If that number is above 30%, the house is stretching you too thin. And a financially stretched homeowner makes worse decisions in every other area of their life. The stress bleeds into everything. Number 3, you have a financial buffer after you close. Not before closing, after. Because a house will break something in the first year. It always does. If you drain every saving to cover the down payment, that first repair sends you straight to a credit card.
Joe did not buy that house. Not because he could not afford the mortgage. Because when he did the full calculation, the timing was not right for him. He was not planning to stay in that city for 10 years. His buffer was smaller than it should be, and the total monthly cost sat at 34% of his income. So he kept renting, and he took that $1,100 monthly difference and he invested it. Every single month, automatically. Not because renting is always better, because for Joe, right now, in his specific situation, the numbers told him to wait. And here is the thing about that decision. Joe made it from clarity, not from what his parents expected, not from what his colleagues were doing, not from that feeling that renting means you haven't quite made it yet, from his own numbers, his own timeline, his own life. That is all this video is asking you to do. Not to avoid buying a house, not to rent forever, just to know the full picture before you sign. Because a home purchased with complete information is a sanctuary. But a home purchased out of social obligation is just a very expensive lesson. So here is my question for you. Do you own or rent right now? And do you feel good about that decision? Drop it in the comments. Be honest. Because I think a lot of people watching this have never actually asked themselves that question.